Welcome to TheoTrade. This is Don Kaufman. It's May 23rd, 2025. Just a few minutes after the cash close here on this Friday afternoon. S&P's closing in the red once again, down some 42 handles. NASDAQ off by about 1%. Coming into the Memorial Day holiday weekend, obviously markets are going to be closed on Monday. Look, let's get right down to business here. Here's why the bears, they look like they're making a comeback. I'm going to give you a lot of good reasons right now that, something I've been talking about just week in and week out, right? The merry-go-round of risks is coming back into fashion in this marketplace. All right, let's jump right into it. So let's start with some S&P levels. And one of the first things I want to do is come out of the, this is just a 1 minute. I was just looking at intraday trade. I mean, look, intraday volatility, obviously back to some extent, but we start to actually look like a 30-day, 1 hour. Okay, the sell side activity this week, it could have been significantly worse. There's no question that we ended, quite a bit outside of what we kind of expected for the week. But look, we're still well above the that kind of gap print in here. And let me just kind of zoom into this for a second so everybody's aware of what I'm talking about. The gap print, where basically everything is going to be okay. We basically gapped from 56.70, okay, gapped all the way to almost 57.50, and then have headed higher. Okay, so ending right now this week in the S&Ps at none other than 5,800, or in this case 5,811, is again, I think we actually got out relatively unscathed, but there's a lot of risks ahead of us. There's just no question about that. I'm not trying to get everybody like all bared up with no place to go. I want to show you right off the bat, okay? One of the things that just not enough, I think retail traders are really looking at, and that's this. Let's come right to the SPX. So one of the things I want to do right off the bat is let's all cut the garbage about, this level and that level. Who cares? You got your MACD, you got your Fibonacci. I got your Fibonacci right here. It's your 618 right here. Here's something that's really interesting and very, very definitive. Okay, you can say whatever you want about a marketplace, but here's one thing that a lot of people are not paying attention to. I'm going to freeze the screen right there. Okay, that's a massive, massive move. Obviously, it's the tariffs. Nobody expected it. Oh, it was crazy. Yeah, well, it happened here where we actually breached expected move again. This is almost what? Okay, massive breach. This is like a 2 standard deviation, and then again today. All I'm pointing out here, again, for those of you that maybe are a little new, you have no idea what you're looking at. This is the SPX, okay? And in the SPX, this is what I often term as the mother of all products. And the reason I say that is in terms of notional value, that's like how much dollars are actually trading through. There's no product that even comes close to the amount of capital that's trading through the SPX, because the SPX is a $5,800 product and it's doing, okay, you want to see how many contracts it's doing? Let's get into it here. Why is this important? The SPX, scroll to the bottom of the screen, look at some of the contract size. SPX did like almost 3 million contracts today. Like, whatever, man. By the way, the spiders, they're joined at the hip with the SPX. The spiders, okay, are good for what? Another 8.7 million. So combined, what do you have? Close to 12 million contracts. The entire marketplace might do 60 million contracts today, okay? And 12 million of those just came from the SPX and the spiders. So, I mean, it's pretty shocking right over there. Like, so, all like 1/5 of the volume just came from effectively 2 products. But the SPX is a magnitude, it's like 100 times bigger than most products out there. Obviously, it's 10 times bigger than the spiders, but it's just a huge magnitude of capital. And what I'm trying to point out by looking at expected move is how the options marketplace handicaps, okay, forward risk. So each week we look and we say like, okay, this week the S&Ps are supposed to move $100 higher or lower. How do they end the week? And if you say, well, they're inside the expected move, anything inside the expected move is, well, by definition, expected. It's just about a 68% chance of falling inside the expected move. It's 1 standard deviation. But what we're seeing week in and week out, and you got to really get a handle around this. It's hard for people to come to grips with this. The SPX can't handicap anything. It's all over the place. Okay, like literally the marketplace is screaming, I can't figure out what's going on. And that's why I say, like, drop all the garbage with the levels. Like, look, markets love to latch on to good levels. But right now, when you look at like expected move, we can't even handicap like forward risks. Okay. We can't even hit the broadside of a freaking barn right now with trying to handicap risk. If we could, you wouldn't have these massive breaches of expected move. So when I say like, oh, stop with this and stop with this, and everybody's like, oh, I'm sure we're going to do this, I'm sure we're going to do that. Okay. What you're getting right now is an unruly marketplace. What you're getting is a marketplace that markets go through periods of incredible efficiency, and then they become relatively inefficient. And the more we break out of these expected moves, and again, this one is my opinion, but the more we actually break out of these expected moves, really, the more that it becomes advantageous, okay, especially on the retail side of trade. Like, I love this crap because this is where the marketplace doesn't have a grip on itself, okay? You feel, I don't have a grip on anything. No, this is when you start using like in-out spreads. You get back, you get hedged, you reduce risk, use spreads. And I keep saying this week in and week out. What I've been saying is like, I don't care if you want to be bullish, but if you are bullish, what have I told you? Use spreads. Why? Because eventually we're going to come down. We're going to come down hard. Okay. And that has nothing to do like, oh, so he's bearish. That has nothing to do with it. Like, what has to do with it is unruly moves. And the marketplace is like ripping itself apart because it's having an extraordinarily difficult time of handicapping literally the administration, which I think most people would agree with that statement, right? You're like, you can't handicap this administration. Well, it's really wild right now. There's just no question about it. You're getting 3 sigma moves and 2 sigma moves, and that basically means 2 standard deviations outside. This move this week, okay, it's of no surprise we ended up outside the expected move. But again, people are saying, well, this thing came out of left field over here. Like, no, come on. We've been warning of risks. Nothing has been determined. Not a single thing has been determined on the trade front. Okay. Oh, we're very close to a deal with what? Nobody? Okay. Maybe Great Britain, the UK, maybe a deal. Nothing is inked yet. So everything is pretty much up in the air. So the administration takes a shot, obviously, over at the European Union. The markets panic a little bit today, but that's what I term the merry-go-round of risks. Okay, I literally said last weekend, the merry-go-round of risks. What was going to happen was, what was going to take center stage? I said bonds. Okay, unequivocally, the bonds this week are why the markets initially dropped. The markets dropped this week, predicated, and that was the big precipitous drop we saw earlier in the week, predicated on what? There's fears, there's debt fears right now, and they're real. Okay, and we're going to come back to that in just towards the end of this, and they're real, those debt risks. But then all of a sudden, now our focus is back on trade. Okay, you have to understand that the SPX can't handicap risks, and now we're going through this merry-go-round of risks. When I say it's a merry-go-round of risks, we just keep bouncing around like everything is fine, it's fine, we're rallying back, and all of a sudden the merry-go-round of risks comes back into play. And once you enter into what I would term like that house of horrors, it's hard to get out of it. So it's one of the reasons why here, this is probably why some of the bears are going to be making a little bit of a comeback right now. There's no great scenario right now moving forward. There just isn't. Like, unless we literally come up with a deal real quick with like China, all of a sudden fears of China are going to come back into and they're going to surface because, if he's not getting along with the EU, he's definitely not going to get along with China. That merry-go-round of risk is right around the corner. There's just no question about it. Nevertheless, it's important out there. Again, when I think about the merry-go-round of risks, the 2 that are on the table right now, it's going to be tariffs, whichever tariffs you want to look at, and it's going to be bond markets, which is going to be spending. And this, the big, beautiful bill, again, I'm not getting into the politics of it, but the big, beautiful bill is possibly a big, beautiful bond vigilante dream out there. So the bonds, if they continue to sell off, unequivocally, the markets are going to panic. It's going to be panic at the disco because the interest rates are starting to soar. I mean, everybody knows this and everybody's starting to rationalize it, in different ways. But once the 10-year cracked above 4.5%, okay, it's on now. Now everybody in the whole world is paying attention. We literally said this in last weekend's video. It's going to crack higher. It's going to crack 4.5%, and it's going to cause a little fear and loathing inside of the marketplace. And again, you can't necessarily handicap how that's going to play out in the marketplace, okay? But you know it's not going to be a positive thing for S&Ps. And there could be considerably more upside. You start getting closer to like 5%, they're going to have to do something. When I say they, okay, the Fed, the Treasury, like people are going to have to get on this thing. So as I said, let's reiterate a couple of points already, okay? One of the points is the market right now is so unstable that it can't figure out what its forward risk is supposed to be, okay? And that's predominantly because you have this merry-go-round of risk. It's just keeps coming back to kind of haunt you. And although everything is fine for a period of, like 3 weeks, okay, sooner or later, here it comes again. And we're back into that notion now that there's nothing good ahead of us. And by the way, it was literally went from there's recession fears, the world is coming to an end, to literally banks were like, cancel the recession, everything's going to be all right. And then this weekend, they're probably like, no, man, maybe we might have a recession again because now the EU might have 50% tariffs on them. Oh no. I mean, it just keeps coming. It just keeps coming. Now, with that, let's start to talk about risk, because it's all for nothing. But, when I say that, maybe the bears are making this comeback over here, I pay a lot of attention to VVIX. The VVIX is the volatility of the VIX itself. And all that this displays, okay, and really when it comes down to it, people try to handicap all these different levels. Like the 110 level in here is of critical importance, because what it displays is that the professional side of trade, they're rushing in and buying hedges. And you're like, what does that mean? So the VVIX is the volatility of VIX itself. And when the VVIX goes higher, what that should impart upon you, and I've got all kinds of positions in volatility, what it tells me is that traders are coming in there and they're rushing to buy calls to mitigate, which is control, downside risk in the S&Ps. So when you rush in and start buying, they're literally buying volatility. And when you're buying volatility, it causes the volatility of volatility to go higher. And that blows people's minds. But it's a great way to actually look at this thing called VVIX. And when the VVIX gets above 110, it effectively says the professional world is hedging. And that's, by the way, that 110 number, okay, it's not just my number. I mean, that's something we've been looking at for a long time. And basically since the VIX has had options on it, we've been looking at things like VVIX, and cracks above 110, okay, it's duck and cover. So when you got the VVIX back above that 110 region, I don't care if it's there for 5 minutes, you're kind of back on the clock for heavy amounts of risk. It just basically means even if the markets rallied on Tuesday, remember the markets close on Monday, but if the markets rallied next Tuesday, it doesn't make a difference. We already cracked the 110 region, which means it's on. That's the sign. For the next 2 to 3 weeks, you got to be on your game at this point. And I'm letting everybody know, you better be on your game now for the next 2 to 3 weeks, because even if we rally back, okay, they're going to come back in, because if you start to relinquish some of those hedges, that can actually cause volatility itself. You're like, what? Yeah. By the way, the positions in volatility can cause volatility. And it's a wild thought. Speaking of volatility, let's go look at the volatility futures. Why do I look at the volatility futures? Because the volatility futures, it's contango, it's backwardation. Oh, those are fun terms for the whole family. The bottom line, though, with volatility has come back to a very ambiguous area. Volatility has basically completely flattened out. It doesn't tell us that we're going into, hell in a handbasket. But the fact that volatility is flattened out, it says that risk is basically right now the same as it is all the way out to October. That's not a healthy thing, because they're saying the risk is so extreme right now that, and right now being 26 days from now, that 152 days carries the same risk. And you would think to yourself naturally that 152 days should have a lot more risk than 26 days, but that's not true. They're basically the same. So the vol skew is completely flattened out. And what's amazing about that, okay, and I'm deadly serious about this. This is one of the reasons I'm telling you, if you don't think, oh, bears are not making a comeback, man, we had a little, the market backed off a little bit. Okay, well, yeah, wake up. And I'm going to tell you why you want to wake up, because that vol skew, you had 2 days of sell side activity, and holy crap, the vol skew flattens back out again. Okay, they're looking at this and saying like, listen to me, this crap is serious. The VVIX cracked 110, check. All of a sudden the vol skew flattens out, check. You get, any one of these alone is like, okay, risk can come back in, but you got two of them in there. Now we're a little bit nervous over here. Then you put three of them, put in the fact that the expected move is all over the place. Like the marketplace is just screaming, you're like, I don't even know what to do with myself. The market's getting manic, people. That's why the VVIX cracked 110. That's why the vol future curve flattened out. That's why the SPX can't handle, handicap risk. And I know that people are going to spend like the weekend like, well, let's explore some levels. Who the hell cares about levels? No one's going to care about levels if we start going into a tirade again. And the market's on the verge of just that. Next in the docket, tech sector. Let me show you something else that's interesting. So the SPX makes a pretty significant crack lower. Okay, that's very clear. You start looking at stuff like Microsoft and apply expected moves to it. Microsoft didn't crack its lower edge of the expected move. Okay, it did not. Apple, where's Apple? Apple got absolutely clobbered this week. Apple was also in the crosshairs, though, of, the administration as well. Amazon, where'd Amazon fare? Right to the lower edge of the expected move. Now, remember, the SPX closed outside its expected move. Go to Google. Where's Google? Google was almost at the upper edge of the expected move. Remind you, I'm actually bullish in Google. Then we have Meta. Meta, okay, just above the lower edge of the expected move. And Tesla, okay, Tesla, just middle of the road, nothing going on. Nvidia, okay. Broadcom, flat on the week. The point that I am trying to make, by the way, we didn't even bring up Netflix. Yeah, sure, what the hell, flat on the week. All right, the reason I'm bringing those up is to point out bottom line tactic here, okay. Tech is strong on a relative basis. And I think that people are looking at this a little bit wrong. Like you can look at tech and say like, no, man, tech held up. You might say the S&Ps are going lower. I'm not saying the S&Ps are going lower. I'm saying though, if they are going to go lower, rut-row, tech, okay, held up this week. That's not good because it leaves this just gaping hole, okay, to the downside right now. That tech is strong on a relative basis. And, it's nice and easy when people say, well, we're going to rally back up, and that's fine. Maybe we do get a bid back under us on Tuesday because of some news. But I am telling you, if we're going to go into sell side activity, you want to be short inside of tech. And if you're going to do it, you actually want to use spreads. Don't dare go out don't short the Nvidia. You can't short Nvidia. Its earnings are coming next week too. But I'm just making a quick point with this. Literally, Nvidia's earnings are coming next week. But use spreads. Okay, look at this. These stocks are actually holding up, and with Nvidia's earnings next week, that's going to be taking center stage. If this thing were to like miss or something, holy crap! It's going back to the merry-go-round of risks. But I can make an argument that Nvidia, even if it beats, okay, could actually sell off because a whole lot's priced in here. This thing had over a 50% rally from some of the recent lows. Okay, tech sector strength is a big concern to me. Again, tech sector strength is a big concern to me because several times throughout the course of this week, we also saw heavy degrees of correlation, meaning that we had 85, 90 products down earlier today. We rallied back a little bit, but the fact that tech isn't getting annihilated, Apple's getting annihilated, but tech is not, leaves us extraordinarily vulnerable. Now, the last kind of nail in this marketplace, it's bonds. Okay, and I think that a lot of people on the retail side, they have a tough time in the bond market. They don't really get what the bond market is or why I describe it. It's just basically let's just chalk it up to this: the lower the bonds go, the higher their interest rates go. The lower the bonds go, the higher the interest rates go. And higher interest rates, that's not what markets want to see. Markets like free money, which means cheap money, which means lower interest rates. And right now, okay, we might be on the verge, again, in the terminology of bond vigilantisms. Basically what it means, okay, is U.S. debt might be a little bit out of control. Maybe they're spending a little bit too much. I'm not here to get into the politics. I don't give a crap, okay? What I do care about at this point, though, is that you understand, okay, that this is a monumental move to the downside in bonds. I want to pull up a forever chart in bonds. You understand how significant this is? Well, this was a sell side to help curb inflation. Yeah, well, inflation doesn't really seem to be an issue, except bonds are basically facing, lows. How low? Lows that they haven't seen since before the financial crisis. And right now we got more debt than ever. And what people don't really get is that the higher the interest rates go, which they're going a lot higher, I know that you guys are all worried about like, oh crap, I'm going to have to pay more on a mortgage. That's not why I'm concerned. I'd be more concerned because the United States debt will explode with higher interest rates. Like they can't handle 4.5%. And what happens if nobody's willing to buy these things? Okay. That's where things get crazy. There is a crisis going on right now in Japan with ultimately their bond market. Japan tries to control their bond market through what's termed yield curve control. They've lost control. Right now in the United States, okay, we're not in that just yet, but the bond market is sending dire warnings about spending, okay, to the government. Are they actually listening? Okay, and that's not to get political. Are they listening? Hell no. They have no choice. They're going to spend right now, okay? Because if they don't spend, we're going into a massive recession. This would be the worst time possibly to cut, dramatic spending, and we'll go into a massive recession if that actually occurs. So what they're going to try to do, instead, they're going to try to spark the economy up, okay, generate enough capital to ultimately, maybe bring in some revenue through tariffs, yada, 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 okay? They're going to try to spur the economy, okay? Well, the bond market's not having it. The bottom line is this: if the bonds continue to sell off, it's going to be a tirade inside of the S&Ps. They're going to come for the S&Ps in a big way because you know what? Higher interest rates are also, okay, you think Apple's impervious to anything or Amazon's impervious to anything, but it will actually curb at that point consumer spending. Again, bonds, they may define markets, not just right now, but for years to come. And we're on that verge. We need to see something critical change in this marketplace where the bond market reacts by people ducking and covering and buying bonds. So you could get a situation where the market started to sell off and we were buying bonds, okay, to reduce risk of the S&Ps. I don't give a crap. That'll actually work, right? So all of a sudden the S&Ps start to sell off and there's nowhere to run to, there's nowhere to hide. And this is where all the crypto people come out. But, crypto people, okay, why did the crypto market actually sell off today? Why did it sell off today? Because we were, selling bonds, we're selling this, but we also sold crypto. This is going to be a wild time. Maybe they buy gold. Okay, it's going to be a wild time. You have some really, really critical risks kind of facing us in the near future. And that's why I'm saying, hey, these are some of the reasons that bears are making a comeback. Last, but definitely not least, let's go back to the expected move for a moment, because the expected move is so important to me. So we cracked the lower edge of expected move. By how much? Look, we were supposed to move like $100 this week. We moved more than that, right? Let's just call it like $150. So you're supposed to move about $100 this week. It was a $96.83 expected move. You move about $150. So it's about a standard deviation and a half. Next week, well, what's interesting about next week, there's a $126 expected move. You go, where'd you get that from? I opened up the 7-day options. Wow, here it is, 127. Okay, there's about a $127 expected move for next week, which is significantly higher than this week. The only difference is next week's only a 4-day week. Holy crap, which means the volatility has actually exploded for next week. Okay, put your helmets on because the market's not open till Tuesday, but when the market reopens, you're going to reopen into some heavy vol. You're expecting a $63 move, okay, just on Tuesday alone. You don't like that? Okay, you got 4 days and almost $130 of movement actually priced in. So people, okay, what a difference just a few trading sessions has made. We went from it's the most spectacular, hated rally of all time to 2 days of sell side activity, okay? And you can already smell some of that fear out there. Anyway, for me, that's it. Enjoy your Memorial Day holiday weekend. On behalf of everybody here at TheoTrade, thanks everybody for tuning in. Have a wonderful weekend. Bye-bye.